Good morning, everyone, and welcome. My name is Anil Jagmohan, and I'll be your host for this morning. Consistently aiming to generate absolute returns, particularly within a global equity context, is really no easy task. And you can often look wrong for very, very long periods of time. And especially in this environment, when markets are so volatile, valuations are still elevated, and of course, investors are fearing the threat of inflation and rising interest rates. And obviously, what's really on top of investors' minds as well is the subsequent impact on asset prices and the increasing risks of capital loss that investors may end up suffering. And that's why you really need to be astute in finding the right opportunities in this environment. Today, we're joined by Andrew Headley. Now, for those of you who haven't met Andrew previously, he is a fund manager and head of global at Veritas Asset Management. Now, Veritas managed the Net Group Investments Global Equity Fund, which is a concentrated portfolio of about 25 to 40 stocks where they have a very strict valuation discipline. They only invest in quality companies from around the world, and they invest with an absolute return mindset. Now, particularly in all of this, they are really, really focused on capital protection. Good morning, Andy, and how are you?
Good morning, Anil. I'm very well, thank you very much for asking, although it's a lot colder here in the UK than it probably is with you at the moment.
Yes, it's really hot here, actually, now that you mention it. Andy, interestingly, people are still talking about the very interesting thoughts that you shared with us at the last Global Fund Manager Workshop regarding developments in the metaverse. And it's amazing what you shared with us. And for today, there's actually a few more interesting questions that we want to pick your brain on for today. And I do remember that the last time we chatted, you were very determined to focus on your emphasis on generating absolute returns. So how about we delve a bit deeper into that for today?
Yeah, that would be great, Anil.
Okay, brilliant. So I've got a couple of questions for you. Let's get through them one by one. And I'm very interested to hear what you have to say. So the first one, Andy, is just about what risks you actually see for global equity markets over the next 5 years or so that would make this focus on generating absolute returns particularly rewarding.
Yeah, I think that's a really great question at the moment. Obviously, all investors, as we sit today, are suffering from greater volatility that we've seen probably since the end of last year and certainly through the first month of 2022. But when we look at the market, we think there are a number of risks outstanding that perhaps aren't being taken into account in overall valuations. Now, to put it in some context, we've had kind of 20 years of declining interest rates. We've obviously had a huge amount of policy input through quantitative easing, low rates, etc. And that's led to asset prices rising, which has been a kind of stated aim of these policymakers, is to put asset prices up and hope for this trickle-down effect of wealth. But as we sit today, we think that those actions of policymakers around the world have led to some risks that really aren't necessarily being fully reflected today by equity market participants. So obviously the first one is valuation risk. We think valuation risk today is quite high, but valuation is a very poor short-term indicator. So if you look at these long-term and pretty much any valuation metric, but if you look at the longer-term metrics, so for example, the Shiller PE, the cyclically adjusted PE, there's a very low correlation between the cyclically adjusted PE and the following 12-month return. So the PE could be high and returns could be high, or they could be low, the PE could be low and vice versa. But if you look over 5 to 10 years, there is a very strong correlation between the cyclically adjusted PE and your future return over that 5 to 10 year horizon. So as we sit today with the cyclically adjusted PE around 40 times earnings, just below now, that equates to somewhere around a low 0 to kind of 3-4% annualized rate of return expectation in equity markets. And actually that's about what we see if we look across our universe companies and look at the average valuation across those companies. We see kind of 3-4% annualized rates of return for the next 5 years. So valuation risk we think is real, but we don't know when it will come to fruition. As I say, it can take any time over 3 to 5 years. But the other risks I think that are out there that are not necessarily taken into account are there's a liquidity risk. Obviously, central banks have been pumping a huge amount of liquidity into markets. The Federal Reserve have been very clear that they're worried about inflation. So that liquidity is going to start being withdrawn from markets, not just stopping increasing it, but over time they will withdraw that liquidity from markets. And that's likely to have an impact on asset prices because they will stop being the marginal buyer of treasuries. Other risks that abound, margins are very high today, and we think there's a margin risk over time. We think that the share of earnings that go to labour, so wages, will increase. We think that there's going to be pressure from inflation for employees to get paid more, and so we think that it's likely that we'll see an increase in wages, and that will come at the expense of corporate margins. So at the marginal dollar, we think will go to the worker rather than to the corporate. And then there's a couple of other risks we'd see out there. So we see a geopolitical risk, which is rising. Obviously, we've got the potential for Putin and Ukraine. President Xi has said that he wants to take back Taiwan during his tenure. We don't know what his tenure is, but he wants Taiwan to become part of China again. So there's all these geopolitical risks out there, which we think are not necessarily being taken into account. And obviously, there's an inflation risk. Inflation has risen. It seems that the central bankers are behind the curve. Current expectation is for the Fed funds rate to end 2022 at 1%. I mean, if it gets to 1%, it's still a long way below the level of inflation. So we have these negative real rates. So there is a likelihood that the Federal Reserve and other policymakers have got behind the curve on inflation, and there is a possibility, and nobody really knows, but there's a possibility that inflation starts to run away with itself, which would mean that the central bankers would have to step in and become much more aggressive. So we see a lot of risks that are abounding, but yet valuations, despite the recent decline, so we've seen equity markets decline in January, but despite those declines, we think that valuations are still very high in general. And so, returning to your original question, what we have to try and identify as global equity investors with this absolute return mindset is companies that we think can deliver over a 5-year horizon, where we can deliver good absolute returns, even in quite a difficult environment that we envisage could occur.
Thanks, Andy. And just something which you already alluded to, but I just want to zoom into that a little bit more. So which areas, particularly within global equity markets, do you see as being attractive for long-term quality investors?
Yeah, so we think that there's two answers to that, really. One is that the companies that we own, as you know, that we own, as you said, between 25 and 40, and so they're all idiosyncratic companies. We identify them and we find these companies and analyze them and end up owning them. So they're all a bit different, and so the ideas can come from anywhere. And so it's not necessarily the case that we have a particular area. But having said that, I do think that the areas that have been overlooked for kind of the last 5 to 10 years do depict much more valuation for us. That there's much more opportunity in those areas for us to invest. So good example would be aerospace and defense. Defense companies, they're very cash generative, very secure. We know that the big defense companies, that they're one of the few sets of companies that I can say hand on heart, I know these companies will be around in 20 or 30 years time. It's very difficult to say that about many other companies, companies in telecoms or consumer goods companies. It's hard to know whether they'll be around in 30 years time, but the defense companies, because of what they do and the nature of their products, they will definitely be around in 20, 30 years time. So they have this huge long duration. Now, because of ESG factors, a lot of investors have decided that they can't own areas like aerospace and defense. And so their shares have become very cheap. I mean, they're hugely cash generative. Their contracts are backed by state governments. They show a reasonable level of growth because they tend to be on these big programs where they can generate high margins or higher margins on the big programs. And so we see some of these companies as being very cheap. We can buy some of them. We own BAE in the portfolio. It's currently on around 12 times earnings. It'll be doing 50 plus pence of free cash flow in the next couple of years on a £5.80 share price. So, it's on an 8% free cash flow yield, and it's growing, and it's very, very secure growth. And so we think that these areas where we can still buy these companies on low ratings, but we think they're very high quality and they have high returns on capital employed. I mean, they're very profitable businesses. So we think there are some areas that have been overlooked by the market that give us this nice opportunity to earn good absolute returns over the next 5 years. And just on that point, I think if over the next 5 years a portfolio can deliver somewhere between, let's say, 10, 12% annualized rate of return, then I think you'll be doing very well given the context that we're starting from. But of course, delivering 10 to 12% annualized rates of return over the last 5 years would have been huge underperformance. And so you have to bear in mind the context that you're investing in, that as we stand today, we think a 10% annualized rate of return over the next 5 years, which certainly we think something like BAE can deliver, will be huge outperformance. But if we'd done 10% in BAE over the last 5 years, it's underperformed the market by 6 or 7% a year.
Yeah, that's really interesting, Andy. And maybe just the last one then, just to conclude our session for today. So, within all of this, why would you say Veritas is well placed to deliver these absolute returns, just given the environment that you're speaking about?
Yeah, that's a really good question. And I think there's two answers. One is, I think, the real answer, and one is like really an example. So the real answer is that it's the mentality that we've had since we started the business. So when we started this business in 2003, we started with the idea of delivering for clients absolute returns. And so we don't look at the benchmark. We don't look at how the benchmark is composed. We're very focused on delivering absolute returns for clients. And so I think it's to do with the mentality of the way that we analyze every single company, the way that we talk to management teams, the way that we identify investments. Everything is built into the process, and everything is about delivering these absolute returns. And so that's I think the actual answer. But I think the second answer is that we have the proof of this over our history. So we started in 2003 at Veritas. We've obviously invested all the way through the financial crisis. And as you will see through that period, our returns were exceptionally strong. So certainly relative to a market. So our focus on absolute returns really worked during the last major downturn. And so if we happen to come into a similar downturn over the next 2 or 3 years, which is perfectly possible, then it's likely that our absolute return mentality will work again. And we've certainly seen it every time we've had a serious decline in markets. So December 2018, markets were down substantially. March 2020, markets were down substantially. And every time we've seen that, our portfolio substantially outperforms during those periods. And that's not because we're not owning companies and not because we're not invested. It's because we're focused on absolute returns, and the companies that we invest in are very stable, cash generative companies that deliver those returns, whether we're in a good economic environment or a poor economic environment. And so I think they're the two factors that you need to take into account as to why I think Veritas are really well placed to deliver good absolute returns over the next 4 or 5 years.
Thanks very much, Andy. And in fact, yeah, I've also seen that graph of your return signature, which very clearly shows how well you and your team protect capital when markets are doing poorly. So well done on that. And yeah, may the good returns continue. Thanks so much.
Thanks very much, Anil.
Thank you to everyone on the call for joining us this morning. And of course, many thanks to the team at Veritas for helping us to coordinate this event. And of course, where would we be without our expert production team for helping us to pull it all together? We'd really be lost without you. To all the clients on the call, please do also follow us on LinkedIn, where you can access our latest articles, insights, videos, and much more. The recording from today's event will be disseminated shortly and will also be uploaded to our YouTube channel. Please do remember to join us for our next Responsible Investing Summit, which focuses on biodiversity at risk and which takes place next week, Tuesday morning. The invites for this event have already gone out, so please do chat to your relationship manager for more information. Until next time, best wishes to you and your loved ones, and thank you from all of us here at Net Group Investments.